Manish, it is live now.
Good evening, friends. A very warm welcome to all of you. Third and the most important live budget session that we are going to have from the Text Today network. Earlier, we have already discussed on the provisions of budget in Hindi on Saturday, and on Sunday we had discussed it in Gujarati, and now today we are going to discuss it in English. We have selected all these three languages because we want that all our viewers, though whatever dialect they speak, can be easily be accommodated, and we can prove that we are not only withheld by any language, but education and knowledge flows across. With the opening remarks on today's budget, with all the Sensex roaring up and all the advantages that this budget has given to a lot of many people, the most important part that comes across is of the tax consultants and the professionals and the chartered accountants. And at the end of the day, it is they who take out the main census of the budget and come across to you. So today, first of all, we will be discussing the indirect tax proposals, and then we will be moving to the direct tax. First of all, I would request C.A. Chintan Popat of Tax Today. He's associated with the Tax Today team since a long period of time, and I would request him to introduce today's first speaker, C.A. Druvang Parikh from Narration Company, who's going to deliberate on the indirect tax proposals that have been published for the financial bill to 2021. Chintan bhai.
Thank you, Monish bhai. I welcome all the delegates of this webinar, which is the third presentation of Budget 2021-22. Let me have an opportunity to introduce Druvang Parikh in a very crisp and concise manner. He is a partner of Naresh and Company, a firm based at Baroda. He is a national faculty of GST appointed by ICAI. He had been a co-opted member for 1920 in Indirect Tax Committee of ICAI. He took more than 175 lectures at various forums with respect to GST and other allied matters. So I welcome Druvang Bhai Parikh to the Tax Today group. It's a wonderful time where we can have your deliberation on the budget 21-22. So floor is yours, Druvang Bhai.
Thank you, Chintan Bhai.
Before Druvang bhai, you could start. All those viewers who are watching us live on YouTube, if you have any questions with regards to the budget, you can always type in those questions. We will try and cover it in the session if possible, or we would personally put your email addresses and your mobile numbers as well. We will definitely get back to you with the answers of your queries that you have posted. Thank you. With that, Druvang ji, for you.
Thank you, Monish Bhai. Thank you, Chintan Bhai. With your permission, Monish Bhai, I would like to start with the today's session, the first session on GST or the indirect tax related changes that has been proposed in this budget 2020-21-22. Good evening to one and all who are listening us right now live. First of all, if I talk about this budget is the budget of Atmanirbhar Bharat. This budget is the budget of an expression of 130 crore Indians who have full confidence in their capabilities and their skills. This budget has strengthened the sankalp of nation first. This budget has strengthened the sankalp of good governance, has focused on opportunities for the youth, education for all, women empowerment, inclusive development, and strong infrastructure. This is also the milestone year for the Indian history because this is the 75th year of Indian independence. This is the year where 8th census is going to be conducted of the independent India. This is the year of Haridwar Kumbh, and this is the year wherein there is a strong vision for Atmanirbhar Bharat. So, with these words, I would like to start with today's topic, that is the indirect tax proposals of this budget 21-22, which has been announced by our Honorable Finance Minister Nirmala Madam on 1st February 2021. Uh, if I look at this budget, if I look to the speech of the Madam, which concluded on 1st February 2021, what she spoke was, this is the extract. If you can see on the screen, this is the extract of the speech of the Madam, wherein she said that before I come to my indirect tax proposal, I would like to appraise the house on GST. The GST is now a 4-year-old baby, and we have taken all the measures. I mean to say, the government has taken all the measures to further simplify it. She has given some examples of what measures have been taken till date. Few measures have been listed out. One is nil return through SMS. Second is QRMP scheme, that is quarterly return and monthly payment scheme, which has recently started from 1st January 2021, giving relief to more than 93% of the taxpayers across the nation. One is e-invoice, which started with 500 crores in October 2020, and now from 1st January 2021, even all those taxpayers whose aggregate turnover is more than 100 crores are also covered within the purview of e-invoicing facility. Validated input tax statement, pre-filled editable GST return. This is again a welcome move from the government, because what used to happen before this pre-filled editable GST return was, there were various discrepancies in GSTR 1 and GSTR 3B. The taxpayers were getting regular notices from the department with respect to this difference in GSTR 1 and GSTR 3B. Now, this issue has been resolved by government by giving this facility of pre-filled editable GST return, wherein you will get all the figures just like income tax, GSTR, just like ITR 1. The assessee is able to get all the figures being auto-populated in GSTR 3B based on GSTR 1 as well as GSTR 2B. And staggering of return filing process, wherein the government has given different due dates with respect to turnover in accordance with the states wherein the assessee is located, like 20th, 22nd, 24th, etc. Further, the capacity of GST system has also been enhanced, and the madam added that we have also the government have also deployed deep analytics and artificial intelligence to identify tax evaders and fake billers, and have launched special drives against them. And the results speak for themselves, because whenever we open the newspaper in the morning, we come across a case booked by GST department. 100 crore, 200 crore, 500 crore fake invoicing, etc. This is all because of the artificial intelligence, the measures, the deep analytical tools used by the government. And further, she said that they have made a record break collection in last few months. And yes, we have witnessed it. The collection of the last month was 120 lakh crores. As the chairperson of the council, she also assured the House that they will take every possible measure to further smoothen the GST, and they will remove all the anomalies like inverted duty structure. With this, as far as the portion of GST was concerned, she concluded on the GST segment, and all the people who were watching the budget live were of the view that there are no much changes in GST. The reason being that GST is such a frequently changing law that we are getting notifications every week, maybe every fortnight we are getting these notifications. But while reading or while going through the fine print of the budget, the finance bill, we came to conclusion, we were able to know that there are various amendments which have been proposed in GST Act. So we are going to discuss few major amendments that are proposed by this finance bill. Coming to the first proposed amendment, it is with respect to the levy of GST on transaction between club, association, and its members. Why this amendment has been proposed? And let me tell you that this amendment has been proposed with effect from 1st July 2017. That is the date of introduction of GST itself. The before discussing this amendment, let me share an important case law, an important verdict by Honorable Supreme Court in case of Calcutta Club Limited, wherein the Honorable Apex Court held that service tax is not required to be paid following the concept of mutuality. And we know that even other laws like income tax law recognizes this principle of mutuality when it comes to a transaction between the club and its members, the association and its members. There are two contrary rulings from two different appellate authority for advanced ruling as far as GST is concerned. One with respect to between Necklace Maharashtra, and one with respect to Inner Wills Club of India by Honorable AAR West Bengal. If we talk about these two judgments, both rulings are contrary. In a way that in one of the ruling, the Honorable AAR Maharashtra held that GST will not be applicable in case of membership fees and subscription fees collected by club from its members. Whereas in another ruling, the AAR held that GST is applicable. Again, the assessee is very in dilemma. Now what happened? This new clause AA in subsection 1 of section 7 is proposed to be inserted retrospectively, that is from 1st July 2017, to ensure the levy of tax on all these activities or transactions wherein goods or services are involved, and these goods or services are supplied by any person other than an individual to its members, or vice versa, against consideration. Also, it is interesting to see that also an explanation has been inserted clarifying that it is going to have a overriding effect on any other provisions of the law, any other law, as well as any other judgment, decree, or order of court, tribunal, or any other authority. While presenting the first budget, this government has given the assurance that they are not going to bring any retrospective amendment having an impact on levy of tax. Now, the time is the only solution whether this proposition is going to be challenged or not. Let's time speak. Till then, the intention of government is very clear that whenever a transaction is going to take place, whenever a supply is going to take place between an association or its club to its members, there will be the levy of GST on this transaction. Coming to the second important amendment, strengthening of ITC matching provisions. We all are aware about the most controversial rule, that is Rule 36, Sub-Rule 4, inserted with effect from October 2019, wherein the government put a restriction on the availment of input tax credit at the end of the recipient. What restriction government has given at the first instance? The government said that you won't be eligible to avail more than 20% of the eligible credit appearing in your GSTR 2A. That is with effect from October 2019. Then again, this rule was amended further with effect from 1st of January 2020 to provide that this cap is reduced from 20% to 10%. Thereby, the assessees would be in a position to avail only 10% extra credit as compared to what is being reflected in GSTR 2A. And that too on the due date of filing of GSTR 1, that is 11th of the next month. Then what happened? Because of corona, there was a temporary relief given by government that now during this period from February to August, the assessees were at the liberty to take the credit based on their books of accounts, the credit appearing in their books of accounts, but with a condition that this credits are supposed to be reconciled, and whatsoever credit is not reflecting is supposed to be reversed while filing return for the tax period September 2020. Again, an amendment came with effect from 1st January 2020-21. This limit has further been reduced, and now the provision right now is the assessee is in a position to avail only 5% credit more as compared to what is being reflected in GSTR 2B. Earlier, I used to say GSTR 2A. Now I'm using this word GSTR 2B for the reason that the government has come out with a new form GSTR 2B. The reason being the assessees, the trade, the associations have represented that GSTR 2A is a ever-changing form. Once the supplier files GSTR 1, I as a recipient is in a position to see the amount of credit based on GSTR 1, based on the details of outward supplies furnished by my counter supplier. And it was very difficult for the assessors to keep a track of what credit is being reflected when. I mean to say, on 11th the credit might be different, on 12th it might be different, 13th it might be different. So it was very difficult for the assessee, as well as it was to be a situation wherein the tax officers would also not be in a position to reconcile the exact credits appearing on the due date. So government introduced this new form GSTR 2B, which is a static form. And because of this new QRMP rule, again, few representations were being given to the government that what will be the fate of those credits in case where the suppliers are filing return on quarterly basis. The government has also given solution there too, wherein from the current tax period January 2020-21, the quarterly taxpayer can also use the facility of invoice furnishing facility IFF, and they can upload their invoices by using this facility. This facility is optional in nature. So all these problems are being taken care of by government. But there was one issue with respect to this matching provisions. In various high courts, petitions were filed that rule cannot override the intention of the act. Rule cannot override the statutory provisions given in the act. Thereby, the government has proposed to introduce one more clause, clause AA in section 16 subsection 2, providing that the details of this invoices or debit notes has been furnished by the supplier in the statement of outward supplies, and such details have been communicated to the recipient in the manner specified under section 37, and then only the recipient will be in a position to claim credit. It means that if your supplier forgets to reflect this invoice in his statement of outward supplies GSTR 1 or IFF, if he is a quarterly filer, the recipient will not be able to take this credit. Let us wait for the entire functionality. Let us wait for further more clarification. But I'm sure that government will not allow the taxpayers, the recipient, to avail credit more as compared to what is being reflected in the static form GSTR 2B. So now a statutory backup has been given. Statutory backup in the sense that
Viewers,
think
please be online. Might be some
yeah,
issue from
there is
Druvang
some
Bhai.
technical issue that
Yes.
has happened.
Monish Bhai, please, are you there?
Yeah, I am there. I'm there.
Please.
Manish, I would like to ask you one question till Dhruang Bhai joins.
Yes,
That
please.
once this budget is passed, what would be the effect of 36.4, which is allowing 5% more credit? That is 105% credit. Once the budget is passed, would it be available to our buyers?
See, at this point of time, we are looking at the budget proposals, and once the budget proposals are passed, they become the law. The moment this becomes a law, then there is a possibility that there will be an amendment in 36.4 also, subsequent amendment to the rule 36.4, and they might say that now, since that section 16 AA is not allowing you to take more credit than 2A, we will also not allow you to have more credit than whatever is said. So basically, if you see the trend, it started with 20%, it went down to 10%, it has gone down to 5%, and now eventually, at one point of time, this had to come in. Had GSTR 1, 2, and 3 come in at the right point of time, then we wouldn't have faced this issue at all. But since those didn't come on time, these other issues started creeping up, and to manage those issues, this 10%, 20%, or 5% were given across. But eventually it had to go down to zero. And so if the now what will happen is, till date we were always contemplating that, because in the section there is no such provision, section does not overrule the rule does not overrule the section. Now with the amendment coming in the section, the rule will also be overridden. So that will be a major difference that will occur.
Very true. And
Sir,
sir, one more question which has been faced by all our viewers. Yes, Chintan
Chintan.
bhai, there is any update?
no, he has some technical issue, so he's joining right now itself. So till
No
that
problem,
we
no
can.
problem. Yeah. We'll continue with the
Fine,
question till then.
fine.
Yes, Babu.
Yeah. Manish bhai, one issue which is faced by our tax profession from the starting of this quarterly return monthly payment scheme, that we are making a payment through a new head which has been provided by the GST portal, but the amount is still showing on the cash ledger itself. It is not being set off. Whether there has been any communication by you as a vice president of a chartered accountant association, have you had
See,
any communication with the department regarding the same?
officially, this would, I have not got any word on this, but logically, if you ask me, we will have to see the major portion that the tax was always offsetted in your 3B. Now you file your 3B at the end of the quarter. So if at all, whatever amount you are paying has to lie in your cash ledger. So it is properly showing right now in your cash ledger. When you will file your 3B, it will get offsetted. So I think what the system is doing, the GSTN system is doing, is correct at this point of time. Dhruvang Bhai is
Okay,
here
sir. Dhruvam bhai
already.
is back, so let's move ahead, sir.
I think the PPT is still loading. Dhruvang Bhai, are you there? I think he's still not there. Okay, he's here.
Sir, is there? Dhruvam bhai, we are not able to hear you, please.
Sir, you are still not audible.
No, sir, still not audible.
It's not there.
Sir, he is there. I am able to see him,
Yes,
but he's not
he is there.
audible, sir.
He
Audio
is
is
there,
not there.
but he is not
He's
audible.
again trying to connect. Yeah, he's again trying to connect, sir.
No, your audio did not connect, sir.
Monish, by till time we can ask you the question. Okay, this is the budget which is
This is,
going to
sir,
be
what we
implemented.
are facing these days. Yes, yes, yes.
So we should start doing the
Yes.
same thing
Please,
right
Chintan.
from now, or we should wait till the time the I can say it would be converted into an act. Since the act is
Uh,
being
See, you this is a practice that you need to develop with your clients. So somewhere or the other, you need to start off. You cannot wait till the act to come in. See, month on month, we are taking out the differences and giving it across, right? But this differences needs to end somewhere, because at the end of the day, when we are saying that now this is my final ITC, at that point of time, we need to stop it. So, yes, it's an ongoing process that it will take a lot of time to happen. And the mindset of people also needs to change. With this regards, I think, Chintan bhai, before it gets connected into an act, it is always better to start following the practice, so that when the final match is to be played, you are still hitting sixes and not getting out on the very first ball.
very rightly said, very rightly said. This is actually it was the spirit of the law, which we were not able to, but somehow
Yes, yes. Had as I earlier said, had 1, 2, and 3 come, then this 5%, 10%, or 20% would not have come into picture only.
then if all the
So
consultant,
what I
all the
feel that they are
professional,
just trying. Yes, sorry.
if they keep on actually having the same practice, then the client would also sooner or later would understand that we need to go by the strict provisions of the law which we need to follow.
Honestly, if you ask me, Chintan bhai, in most of the clients have started following this system. There are a lot of practitioners across Gujarat as well as Gujarat, across India, and chartered accountants who are also following, this system, that whatever is seen in 2B or 2A, whatever is their preference, they are selecting those and moving ahead. Now, don't ask me whether 2A or 2B, because that's a mammoth of a fight by itself. Um,
Sir, as a lawyer, I still contest it very much that when there is no option for a buyer to ask the seller to give the details, it is a mistake on the part of seller. I'm knowing that there is a specific provision now that they would not allow, but still this section is very much arbitrary on the part of the buyer. He is not having any right to do. There was two previously, which he is not
so
having.
I agree, Bhavya bhai, and in the past also we have seen in the case of Delhi High Court, which went to the Supreme Court in the case of
Rise
Arise
India.
India. We have all seen that Arise India saw good sunlight, and it was an accepted majority that no, if the ITC, if the other person does not pay the tax or does not show the portal, that does not mean that I am not a genuine buyer. If I can prove my genuineness, and then I can take the ITC. But then see again, however, it is always case to case basis, and you cannot tell that on a blanket rate you can follow that system. So on a case to case basis, yes, if you have a very strong case, you can always see the courts. And I think over a period of time, this section, because it is violative in nature of the constitutional provisions, this would definitely be in the favor of the customer. But till it is challenged, still there are judgments on the same. We have to follow the law of the land, and the law of the land says that whatever has been shown into your credit ledger, that only should be allowed, nothing more than that. So we got to speak to that and work it across.
Yes.
Dhruvan bhai,
Am I audible?
yes. Now you are audible, sir.
Thank you. Thank you. Sorry for the interruption.
Hey, that is okay. That is okay. We had a great session when you were not there.
Thank you. Thank you. Okay, so moving to the next proposed amendment, uh, this is the most debatable amendment these days. The requirement of GST audit by a chartered accountant, a practicing chartered accountant, or a practicing cost accountant. Now, this budget is proposing to omit Section 35, subsection 5 of CGST Act, thereby putting more onus, because a further amendment is also proposed to be carried out in Section 44, bringing more onus on the taxpayers. Now, no more GST audit is supposed to be conducted, or no more 9C is required to be certified by a professional, by a practicing chartered accountant or a cost accountant, because now the onus has been shifted to the taxpayer himself to file annual return, as well as to give a reconciliation with the audited financial statements or the financial statements. As far as financial year 1920 is concerned, this provision will go on, because even the CBIC has given a green signal by way of a tweet and clarified that for 1920, this amendment will not come into play, but this amendment will come into play from the next financial year. So no more signature of a chartered accountant is required, but yes, we know that who is responsible, or the tax practitioner or the advocate or the chartered accountant, we the professionals are there to support, we the professionals are there to prepare GSTR 9 as well as GSTR 9C. Next amendment is with respect to, next proposal is with respect to interests which is to be paid. So this was also a controversial topic, for the reason that in some commissionerates, the notices were issued asking the assessee to pay interest on the gross liability in case the GST was paid belatedly. I mean to say the GST was paid after the due date. Various notices were issued. Then in the 39th council meeting, the finance minister assured that the interest will be collected only on the net cash liability and not on the gross liability of the taxpayer. Thereby, the cash component would attract the interest consequences and not the entire liability. But again, there was a catch, because the notification was introduced on 25th of August 2020, that is notification 63 by 2020, and this provision was supposed to give effect from 1st September 2020. So again, there was a controversy, which what kind of controversy? That because this provision has been given a prospective effect for the period before 1st September 2020, interest is still liable to be recovered on the gross component, even though the assurance was given by the Honorable Finance Minister. But in this budget, it has been made very clear that this proviso to Section 50 subsection 1 will come into play right from the date of introduction of GST. But it is also to be kept in mind that this proviso will not come to a relief when the return is being filed pursuant to Section 73 or Section 74, or the demand is being paid by virtue of Section 73 or Section 74. So it is a good amendment. All these disputes will now settle, because this provision is going to give effect. This provision is going to get effect from 1st July 2017. Next amendment is with respect to, next proposal is with respect to recovery of tax without show cause notice if liability is declared in GSTR 1. If we go through the provisions of Section 75 subsection 12, apparently what we get to know from the bare reading of this subsection 12 of Section 75 was that government was in a position to initiate the recovery actions without giving a show cause notice in those cases where the self-assessed tax declared in your return means GSTR 3B. If you have declared your liability, if you have assessed your tax and you have not paid that tax, the government, the department was in a position to recover that amount without giving you the show cause notice. But we know that it was practically not possible to file GSTR 3B without paying the tax, and this section was becoming redundant. To again revive this section, the amendment has been proposed in this section in such a manner, and also I would say that what used to happen was, if the assessee wants to declare liability but does not have sufficient funds because of a temporary cash crisis, what they used to do was they used to declare the liability in GSTR 1, but while filing GSTR 3B, they used to reduce their liability proportionate to the funds that were available with the assessee. And then they were getting notices from the department that there is a mismatch between GSTR 1 and GSTR 3B. What used to cause this for the assessee to show a transaction in GSTR 1 but not in GSTR 3B? One is the temporary cash crisis or the liquidity issue with the assessee. And second was the counter recipient was not in a position to avail the benefit of credit if the credit was not reflecting in GSTR 2A or GSTR 2B. So what assessee used to do was assessee used to show this transaction in GSTR 1, but avoid showing all these transactions in GSTR 3B, and subsequently they used to pay the amount either through DRC 3 or in the next GSTR 3B because it is permitted by virtue of Circular 26/26/2017, dated 29 December 2017. But now, because of this proposed amendment in section 75 subsection 12 itself, it will practically become impossible for the assessee to declare a transaction in GSTR 1 but not in GSTR 3B, because even if the transaction is shown in GSTR 1, the department can still start the recovery actions under section 79 without giving an opportunity of being heard, without issuing a show cause notice. So one has to be very careful while filing the returns, GSTR 1 as well as GSTR 3B, after the budget gets, the finance bill gets the assent of the President of India. Now, the next amendment deals with increasing the ambit of provisional attachment. See, what used to happen, the provisional attachment, the provisions with respect to provisional attachment was restricted only to few categories. I mean to say section 62 dealing with assessment of non-filers, section 63 assessment of unregistered persons, section 64 summary assessment, section 67 inspections, search and seizure, section 73 and section 74. Now the section 83(1) is proposed to be substituted in such a manner that it will cover within its ambit all the sections under chapter 12, chapter 14, chapter 15 dealing with demands and recoveries, assessment, inspection, search, seizure, arrest. And this section is being made wide. And also this section will include the beneficiaries as well, at whose instance the malified transactions like fake invoicing are carried out. So what will happen if the commissioner feels, if the commissioner is of the opinion that the revenue of the government is at stake, he can order for provisional attachment of the property, the immovable property, including the bank account belonging to that taxable person or any other person who is considered as a beneficiary of this malified transaction. And this order of provisional attachment will remain in force for 1 full year unless revoked earlier. So giving more authority to the government, more authority to the departmental officers. Next amendment is with respect to zero rated supplies to SEZ. What used to happen was, while supplying goods or while supplying services to SEZ unit or SEZ developer or a co-developer of SEZ, whenever the goods were supplied or the services were supplied or are being supplied right now, in every instance, the supplier is taking the benefit of zero rated transaction as defined in section 16. Thereby, either the supplier pays the tax and claim that IGST as refund, or doesn't pay tax at all and supply those goods or services under LUT option, that is letter of undertaking option. It was not expressly provided in this GST Act that this zero rating will be applicable only for the authorized operations. So this section is proposed to be amended in such a manner that the enjoyment of benefit of zero rating will be restricted only to those supplies which are for the purpose of authorized operations. Now, what transactions are notified under authorized operations? That is notified under SEZ Act. Various services, there are various services which are notified as authorized operations because the uniform list has been given by the Ministry of Commerce so that the Act applies uniformly across the nation. So let me give you an example that if something is provided for a restaurant which is located in SEZ, and if this restaurant service is not within the list of this, the uniform list notified by the Ministry of Commerce, the person supplying goods or services for the purpose of restaurant located in SEZ will be outside the purview of this section 16, will not get the benefit of zero rating. Thereby, the person would be liable to pay tax and the supplier will not be eligible to claim refund. So now one has to be very, very cautious while supplying goods or while supplying services to SEZ unit or a developer of SEZ. And first of all, he needs to check out that whether the goods that he is supposed to supply or the services that he is supposed to supply are going for the purpose of authorized operations. If yes, he can continue with the same practice of treating the transaction as zero rated, either paying tax on this transaction and claim refund, or he can execute LUT with the department and supply goods or services without payment of GST. Next amendment is with respect to refund of accumulated ITC and non-realization of export proceeds. We are aware that this section, this rule 96B has been inserted, White Notification 16 by 2020 in the period of Corona, March 2020, wherein the government has specified that if the export proceeds are not realized within the time period that is allowed under FEMA or the extended time period allowed under FEMA, the person who has taken the refund is required to give this refund back to the government. Till now, the people were, the taxpayers were claiming refund. We are talking about two refunds. One, the taxpayer was claiming refund of IGST paid on exports, or the person or the taxpayer was claiming refund of accumulated ITC when the exports were carried out under LUT option, the accumulated ITC, the refund of accumulated ITC. And it was before March 2020, it was never linked with the realization of proceeds. But what happened? Government introduced this rule, Rule 96B, wherein the government prescribed a condition that if the proceeds are not realized within the time period that is allowed under FEMA or extended time period allowed under that act, the taxpayer is required to give that refund back along with interest. Right? There was no statutory backing to this rule, and that is the reason that this section 16(3) is proposed to be amended to give statutory backing to Rule 96B. So now the refund has been linked to the realization of proceeds. Next amendment is with respect to the mode of the selection of mode when you are involved in zero rated supplies. So what used to happen right now is, what is the practice and what we as a consultant advise our client, that as far as export of goods is concerned, it is better to pay IGST in case of export of goods, because once you declare this transaction in your GSTR1 and pay your tax by GSTR3B, you will get automatic refund because the iGet portal has been integrated with the GST portal, and the assessee, the taxpayer, is getting refund automatically because your return GSTR1 is nothing but return come refund as far as this IGST on export of goods is concerned. So this was supposed to be one of the simplest option while selecting one out of these two options. Then we are aware that Rule 9610 was introduced, and Rule 9610 was amended various times, thereby providing that the supplier who is enjoying the benefit or who is availing the supplies under notification 48 by 2017 CGST, or notification 40 by 2000 CGST rate, or 41 by 2017 IGST rate, or availing benefit of notification 78 by 2017 customs, cannot supply goods on payment of IGST option. So this supplier was restricted for selecting this as an option while exporting goods. Otherwise, it was always an option to the assessee. Right now also it is an option to the assessee whether to go under this IGST payment option or to claim refund of accumulated ITC by going under LUT option. Most of the people were selecting this IGST payment option so that they were getting automatic refund. But now section 16 is going to be amended because a new subsection 4 is supposed to be inserted in section 16, thereby providing that the government, on recommendation of the council and subject to such conditions, safeguards and procedures, by way of a notification, the government will notify a class of persons who will be eligible to export, who will be eligible to make zero rated supplies on payment of IGST option and claim refund of that IGST paid. And the government will also notify a class of goods or services which can be exported on payment of IGST, and rest of the people, rest of the taxpayers, rest of the goods, rest of the services which are not notified will have to compulsorily export, will have to compulsorily go under LUT option and claim refund of accumulated ITC. So again, in this way, the powers are again with the government, with the department to sanction the refund, because when we say it is the refund is under accumulated ITC option and the exports have been made, the zero rate supplies have been made under LUT option, the refund has to be sanctioned by the jurisdictional officer, jurisdictional assistant commissioner, deputy commissioner. Section 152 and section 151 and 152. This section has been substituted to empower the jurisdictional commissioner to call for information from any person. Any person also includes the professionals dealing with this act. Right. So wide powers are given to the commissioner, but the information that will be collected by the officer can be used only after offering an opportunity of being heard to the person concerned. This provision is drastically changed relating to detention, seizure, and confiscation of goods and conveyances. Section 74 of CGST Act has been delinked from section 129 and section 130. Thereby, if the proceedings are concluded in section 74, still the proceedings can go on against other persons under section 129 and section 130, because these two sections, section 129 and 130, have been removed from explanation 1 to section 74. The penal provisions have also been amended. What used to happen right now with respect to, particularly with respect to e-way bill provisions, is if your conveyance is being inspected, right, because of loopholes in your invoice or because of the non-availability of e-way bill, what happens is the officer asks the taxpayer to pay tax along with penalty at that moment itself. And what was the fate of the tax paid by the taxpayer, by the supplier? The recipient was not in a position to avail the credit because the person was paying that amount through DRC3. Whether he was showing the transaction in GSTR1 or not, that was on the supplier. But now a relief has been given in a way that the tax is not required to be paid when your goods are detained, when your goods are seized. Tax is required to be paid normally while you are filing your GSTR 3B. So you can show this transaction in GSTR 1, you can pay your tax through GSTR 3B, and the recipient will be in a position to claim the benefit of input tax credit. However, the penalty provisions have been amended in such a manner that instead of 100% penalty, now 200% of the tax amount would be levied as penalty if the owner comes forward. And if the owner doesn't comes forward, 50% of the value of goods or 200% of the tax payable where a person other than owner comes forward. Earlier, yes, I have mentioned tax was also required to be paid. Now tax is not required to be paid. Tax can be paid at a later stage of time when you are going to file your GSTR1 and when you are going to file your GSTR3B. In case of exempted goods, because the tax is not involved, it would be 25,000 rupees or 5%, whichever is lesser. Now, even the time limit has also been prescribed. The notice is required to be issued within 7 days and the order is also required to be passed within 7 days. So major amendment, in case the transporter wants to release the conveyanced, he can pay 1 lakh rupees and he can release the maximum 1 lakh rupees he can pay as a penalty and he can release the conveyance. In case of confiscation, these are some of the few major amendments as far as GST is concerned. As far as customs, the law of custom is concerned, I would like to highlight few important provision. Because of furnishing of bank guarantee, because of bond, surety amount, what used to happen was the matter was used to go on and on for 5 years, 7 years, 10 years. Now there will be a definite period of 2 years. One more year can there be the 1 more year can be given by of an extension as far as completion of investigation proceedings is concerned under the Customs Act. A welcome amendment. Also, as Madam rightly spoke, that there are various exemptions which are required to be reviewed, and rescinded because they are no more required. So all those redundant exemptions will now no longer be in force. And once the conditional exemption will be notified, the conditional exemption will remain in force up to 2 years. Also, one more section is being introduced, section 28BB, prescribing a 2-year time limit extendable by 1 year by the commissioner for completion of any proceeding under Customs Act, resulting into a notice to be issued in section 28. One more amendment is in section 46 subsection 3. It is also being proposed to be amended in such a manner that filing of bill of entry would be compulsory before the end of the day preceding the day of arrival of goods, including holidays. So now bill of entry is mandatory required to be filed 1 day before the day of arrival of your goods. And also a new provision is going to be introduced therein, which will enable the board to notify the time period for the purpose of presenting of bill of entry in few cases as it may deem fit. Also, one more provision is being inserted, making the law more stringent, section 114 AC in the Customs Act, wherein a penalty is prescribed. Which penalty? Where any person has obtained any invoice by fraud, collusion, the person has obtained refund by fraud, collusion, willful misstatement, suppression of fact, or has utilized input tax credit based on such invoice, fraudulently availed invoice. In addition to the penalty which is being levied in GST Act, If it is pertaining to this IGST, one more penalty will be levied under Section 114 AC, thereby making this law, this penalty more stringent. So this were few of the important amendments. I think I have completed my uh, presentation with respect to amendments well within the time. I would like to thank all the listeners, especially the Text Today group, for giving me this opportunity for presenting my views on the proposals with respect to indirect taxes in this budget. Thank you.
Thank you, Dhruvang bhai. So much you've gone into the depth in explaining each and every provision. We are very thankful to you that you have come up with such a great presentation, and which was an in-depth one as well. Uh, if Ronak bhai, can you see any questions, or Chintan bhai, if you can see any
Sir,
questions are
no
there?
question, no question
No
as of now.
questions.
No questions. If anyone from here would like to ask any question, Bhavya bhai?
Yes, Dhruvang bhai, I would just like to have a question that
Yes, please.
presently what we are thinking of that yes, this 36, the rule 36, which is allowing 105% credit right now.
Right.
What, in your opinion, would be the situation once the budgetary provisions is being enacted
See,
as a way of finance
once
act?
once this finance bill becomes an act, and once the this provision is made live, the provision is made effective, even this 5% rule will go away. That is what I believe, right? And 100% matching of your ITC with the details furnished by your outward supplier will become mandatory, along with the payment of tax by your outward supplier. I mean to say the supplier who is supplying the goods or services to the recipient. So now the credit will entirely be at the mercy of the supplier. So new provisions, the industry have to change the entire scenario. I mean to say the industry have to come up and cope up with this monthly reconciliation exercise which they were avoiding till date. Right? There are various industry, there are various taxpayers who are avoiding this monthly reconciliation. They would now be required to carry out monthly reconciliation. Then only they would be able to get the benefit of this credit.
So, sir, this is what we talk when we talk about companies and big taxpayers. We have got taxpayers who are himself liable to open the shutter of the shop, and he's the person who is dropping the shutter off. Can we accept them to do this monthly reconciliation?
So, what should be the ideal position? This MSME sector, or the up to a certain limit, the government should relax this provision. This is what it should be like, right? Because you are right when you said that the person who is the only person looking after all the affairs, including this accounting aspect, including the taxation aspect, cannot be expected to go through this monthly reconciliation exercise. It is
And
it
and
is
and and
Yeah.
most of the times, what happens is, as rightly Duvang bhai said, is that they come and tell you only one thing, that we know business, we don't know your
yes,
taxes, we don't know anything else.
true,
That is your headache.
true.
Uh,
Thank you, sir. Thank you.
thank you once again,
Monica, over
Duvang
to
bhai,
you.
and I think the first part and the first leg of the last series on the budget has been very well been dealt by Dhruvang bhai. And now we'll be moving on to the direct taxes. The majority of the, always when the budget comes, the salaried employees are the first people who want to look at the budget, or the Aam Aadmi, who looks at the budget and sees whether the tax rate has been reduced, whether they have been increased, whether the income tax slab has gone above, or whether there has been a reduction in that, whether there are n number of amount that can be invested or not. And but to be very honest, I've been reading the budgets since probably from the year 2000, that has been 20 years now. Uh, the finance minister says a very small portion of what it talks about, and the majority of the portion is not dealt with. So, it was very, very important to discuss on the issues of the direct taxes. And whom better to have than Mr. Palak Pavagadi. Um, Palak Bhai is the reason that I'm a chartered accountant today. He's he's my mentor. He's helped me study my direct taxes. And after his classes, I used to, go out wild enough and tell everyone that anyone who has any direct tax question can come up to me. And unfortunately, now that I practice only in the indirect taxes, uh, but then he's always been a guru and a mentor to me. To introduce him, I would request Paurav Bhai Popat from Rajkot to come up on the screen and please introduce the guru, Palak Pavagadi.
Very good evening to all. I am glad to introduce CA Palak Pavagadi. Sir is a fellow member and practicing chartered accountant with the firm name Pavagadi Shah and Associates. Sir is a gold medalist in BCom and was rank holder in CA and LLB too. Sir is having wide experience of 21 years and providing expert service in the area of direct taxes, including tax planning, audit, management consultancies thereof, and also providing as advisory and litigation support on Indian direct taxes and international taxes. Sir is also visiting faculty at CA coaching classes in Ahmedabad. Sir was COPT member of Corporate and Allied Law Committee of ICAI, New Delhi for year 2006-2007, and was also appointed as member of Financial Review and Reconstructing Group working under the leadership of FRRB ICI, New Delhi for the year 2008-9. Sir is a regular columnist in weekly news Gujarati newspaper, Gujarat Mail, for the subject of income tax. So we are having learned speaker who is delivering regular lectures and webinars at various branches of ICI and other esteemed professional associates across the Gujarat and at national level on direct taxes. So please welcome Mr. CA Palak Pavagadi, sir. Please, sir.
Palak sir, the stage is yours. The ground is open, and I know you are better than Sehwag. So I'm sure we are going to see a lot of hidden provisions that are there. The googlies that Nirmala Sitaraman bold will be effectively be batted well enough by you, sir.
Thank you, Monish bhai, Bhavya bhai, Chintan bhai, Paurav bhai. Thank you very much for giving me this opportunity. Thank you, Tax Today. Monish bhai mentioned about his study with me. I would put this way that Monish bhai taught me how to teach, and whatever I am today is because of my old students who helped me in the beginning of my career, who boosted my morale, who put faith on me. And that is, I think, Monish bhai, around 15 plus years back, we were meeting at the office. And at that time, I was not having any experience of handling more than 5-7 people, and that too like Monish bhai. But they have helped me reach this position. So I'm indebted to my early batches of all the students. As far as this budget proposals are concerned, as far as this direct tax proposals are concerned, I'll say that when Honorable the Finance Minister ma'am started the budget, It was all economic provision part A. Thereafter, in part B, she concluded the direct access proposal within no time, hardly 12 to 15 minutes. And everyone was very happy that as there are only 12 to 15 minutes talk by the Honorable the Learned Finance Minister, there are no much changes. But surprisingly, the memorandum runs into 69 pages for the direct access only. And there are number of hidden changes or number of hidden interpretations. I'll pick up those portions which are very relevant in the day-to-day life. And let us begin with the benefits given for the tax proposals under the head tax incentives. She said in the memorandum explaining the finance bill that I am inserting certain provisions for removing the tax difficulties faced by the taxpayer, and it is for ease of doing business, on which there is a big emphasis in the particular budget. And she has also rationalized certain provisions. So the memorandum explaining the finance bill by the Honorable the Finance Minister is divided into these three parts. But we will be understanding the direct tax proposal from different perspective rather than this three division made by the Finance Minister. The first one is on personal tax footing. As Monish Bhai has rightly pointed out that salaried persons or small medium based people are looking at the budget very minutely. What is there for me in the budget is the question for everyone. On 1st February morning, everyone is expecting something from the finance minister. But this year, the Honorable the Finance Minister has not made any correction in any tax rates. Here I'll pick up two things. Number one, there were expectations of many people that as last year, there is a new slab of tax which is inserted by her, introduced by the Honorable Finance Minister. This year, she'll make some relaxation in that new slab also. Like as majority of us are aware that you can get the benefit of old rate of tax with claiming all the benefits under 24B, HP interest, yeah, 80C, that is LIC, PPF, 80D, and all other benefits, additional depreciation and whatnot. But if you want to go for the new tax rates, then you can go to the same giving up all these benefits. The expectation was madam will come forward and say that you would be eligible for new slab with all the tax benefit. But unfortunately, that is not done by her. She has not made any change in the tax rate. I am honest that this year, as they have six-fold investment proposal in different sectors, like textile, they are going to start the textile parks. In infra, she has allotted a huge budget. Health, huge budget is allotted. So they need money. And when they need money, I am of the opinion that it is not good to expect something from the country, from the government. It is not the time to get, it is the time to give. This is an unforeseen situation we are having, and our country is trying to cope up with COVID. In this, it's difficult to expect some tax benefits. She has not given any tax benefit, but let us be positive saying that she has not made any additional surcharge also or additional sales also, which was the talk before the budget that there would be COVID sales, but no, there is no COVID said, no surcharge. At the same time, the talk which is not been approved by her is that long-term capital gain 112A, the tax rate would be changed from 10% to 12% or 15%. 112A is applicable when STT paid and at the time of purchase as well as sales for listed equity shares and sale at the time for listed equity oriented mutual fund. If it is sold through recognized stock exchange, earlier it was exempt under 1038, now it is taxable under 112A at the rate of 10%. The rate of tax has not been increased by her. And as there is no negative news in the budget, obviously there is no positive news, but as there is no negative news in the budget, no apparent negative news in the budget, friends, the market is reacting very positively. Stock market is reacting very positively to the budget. I know that stock market is not the benchmark or not the lab test for deciding whether the budget is good or not. But the reason, one of the reason for stock market reacting positive is there is no negative news. Second, on individual front, and this is something unique. Leave travel allowance. The leave travel allowance is exempted to the employee in the block of 4 calendar year twice. The blocks are defined in the act itself. Calendar year 18 to 21 is the block in which we are in presently. Now, out of this block, last 2 years of the block, that is 2020 calendar year and 2021 calendar year, 2020 almost fully and 2021 till now is affected by COVID. The concept of leave travel concession is employer, say I am working somewhere, employer is giving me LTC. That LTC given by employer to me is, say for example, rupees 1,50,000. Now out of 1,50,000, 2 times in the block of 4 calendar year, if I expand for travel for me as well as my specified relative, then I am able to enjoy the expenditure on travel exempted from this 1,50,000 and only remaining amount will be taxable. This exemption is subjective. This exemption is based on certain criteria prescribed, that rail this much fare or road this much money. Now it is difficult for anyone to travel in this pandemic circumstance, and that's the reason she has come out with a positive correction. She has already announced the same, ma'am has already announced the same, and that is being given effect in the budget. Something unique, she said that any expenditure, my mistake, any specified expenditure. I said any expenditure and then I corrected myself saying any specified expenditure incurred on goods services via electronic mode is also eligible for exemption if you are not incurring the expenditure on travel. Meaning thereby, my employer has given me 1,50,000 rupees for me, my wife, and my daughter. Now, if I'm not able to travel, but if I'm able to travel, then the whole expenditure subject to criteria is exempted from this 150 and only remaining will be taxable. But if I'm not able to travel, then if I incur this specified expenditure, must be incurred between 12th October 2020 to 31st March 21. This is not applicable. Be careful. This is not applicable for the year for which budget is introduced. This is very important. This is not applicable for the year for which budget is introduced. This is applicable if incurred up to 31st March 21. If the specified expenditure is incurred. Now, what is specified expenditure? It is any expenditure on any goods or services via electronic mode. It should not be by cash. It has to be via electronic mode. And it's the expenditure on which GST rate is 12% or more. Try and understand. GST rate is 12% or more. If this type of expenditure is incurred, then such expenditure would also qualify for exemption. My employer has given me 1,50,000. Out of this 1,50,000, it's given for 3 persons, me, my wife, and my daughter. Out of this, what would qualify is whatever the actual expenditure I have incurred for me, 1/3 of that actual specified expenditure, or 36,000, whichever is less. Same for my wife, same for my daughter. Let's assume that I have equally incurred 30,000, 30,000, 30,000 for me, my daughter, and my wife. Then out of 30,000 actual expenditure, I'll be able to get 110, that is 10,000, or 36,000, whichever is less, that would be 10,000 rupees for me, 10,000 for my wife, 10,000 for my daughter. Out of 150, I'll be able to get 30,000 rupees exempt, and remaining 120 will be taxable. Out of 150, 30 is exempt, 120 will be taxable. Now, look at the smartness of the finance minister. This is available to Cellurite. I'm not a man of GST. I don't know much about GST, but basic idea I have. Dhruang Bhai and Monish Bhai would be the best person to explain. But as I understand, generally these salaried persons would not be GST registered. So they are not going to claim any input tax credit, ITC. Number one. Number two, the person to whom you are making must be GST registered and must be having the goods or services on which 12% GST is applicable. So if I'm incurring the expenditure for everyone 30,000, then on this 30,000 I'll be paying 12% minimum GST. That would be giving me 3,600. 30,000, 12% will be 3,600. That 3,600 is collected by the person who is providing me goods or service, and that would be deposited by him into the government account. Government is getting 3,600. On that 3,600, government is giving me 30,000, one third. That would be 10,000 rupees exempted, on which I'll be able to save my tax of 30%. That comes to only 3,000 rupees. So in income tax, I am given 3,000 rupees benefit on a higher side, subject to definitely surcharge and cess. And in GST, she has already collected minimum 3,600 rupees. The first poser here arises that if I have incurred expenditure for myself for 30,000 and it is the service with 12% GST, that is 3,600, would I have to make one third of 30,000 or would I have to make one third of 33,600? If you ask me, we all are going to take one third of 33,600 as the employee is not claiming any input tax credit. So my point is one third of specified expenditure, we are all going to take it with GST. Whether it would be accepted by department or not will be definitely, the time will tell this. But this is first benefit, a small benefit given to the employee. Second benefit, which is taken away from the employee, and this is affecting many big employees. Employees are getting salary, and on this salary, every month employer deposits to the provident fund. Employee also will contribute to provident fund. Now on this provident fund account, recognized provident fund account, employees are getting good interest, 7.5%, 8%, 8% as of today, if I'm not mistaken. Now, this 8% which is received by employee is fully exempt. It is exempt when it accrues. It is also exempt when you get the money from the provident fund account on maturity, subject to certain conditions. Now, what used to happen was that employees have started contributing huge amount voluntarily to their PF account. There are instances wherein employees are contributing lakhs of rupees every month voluntarily to their PF account, on which they are getting good interest, far better than bank, and this interest is tax exempted. This is noticed by Honorable the Finance Minister, and she provided that provident fund interest on contribution made on or after 1st April 21 exceeding 2,50,000 in the previous year shall not be exempt anymore, and it would be taxable on accrual basis. Hypothetically, let us assume that I am working with X Limited. I am doing the job and my PF balance is, I'm working there since last 8 years, and every year the deposit in the PF account by me, employee, is 4 lakh. So 8 years multiplied by 4 lakh, 32 lakh, plus assume 8 lakh rupee another interest is tending to the credit of my PF account on 1st April 2021. Mind well, this is employee's contribution. Employer contribution is a separate part. There is no taxability on employer contribution even in future also, even if it is more than 2,50,000. This particular rule is applicable only for EPF, employee provident fund, that too on voluntary on employee contribution. So that 40 lakh is my accumulated balance, my deposit plus accumulated interest on the same. Now in the current year, I have deposited 4 lakh. If I deposit 4 lakh in the current year, out of this 4 lakh, on 250, whatever the interest I receive would be exempted. On balance 150, whatever the interest I receive will be taxable in the year in which the interest accrues, not on maturity. It is taxable in the year of accrual, meaning thereby 40 lakh was my balance. 4 lakh I have deposited, total comes to 44 lakh. Out of 44 lakh, on 42 lakh 50,000 rupee, whatever the interest I get will be exempt. On 2 lakh 50,000, 1 lakh 50,000, whatever the interest I get will be taxable on accrual basis. Something unique, because see, in the PF account of the employee, the person paying interest would have to maintain any record. I have my reservation, but employee would definitely have to maintain the record, and department would also have to check this particular record. The thing would be interesting in the subsequent year. Now next year, say in 22-23, if this provision is not been rolled back, and in 22-23 I again deposit 4 lakh rupee employee contribution, then out of 4 lakh, on that 42 lakh 50,000 plus interest plus 250 of 22-23, any interest received will be exempt. Earlier year 150, 21-22, 1 lakh 50,000 plus accumulated interest on that 21-22, 1 lakh 50,000 plus 22-23 contribution 1 lakh 50,000. My interest accrued on the PF will be taxable. The exercise is going to be pretty difficult, but this is an area wherein government is able to tax high paid employees, those who are contributing excessive amount into their voluntary PF. This leads me, friends, to the corporate taxation. Minimum alternative tax has been rationalized. There is advanced pricing agreement and secondary adjustment. There is some mechanism given for the same. I'm not involving much into the same, as it is not touching majority. But earlier, dividend was tax exempt in India, you are aware. And as the dividend was tax exempt in India, what used to happen is the foreign company earning dividend income would be paying tax in the foreign country only. In India, it was exempted. But since 2021 financial year, this financial year, the dividend is made taxable in the hands of the receiver. There are instances wherein in the act itself, the rate of tax on the dividend is lower than the rate of MAT, minimum alternative tax. Minimum alternative tax as of today applicable is at the rate of 15%. There are instances wherein this dividend is taxable at the rate of 10%. The learned audience would be able to remember that in the minimum alternative tax for the non-resident, for the foreign company, the provision is if foreign company is getting royalty, fees for technical services, interest, and on this amount, the tax rate under the act is less than the rate of MAT, then such items are excluded while computing the book profit. Same provision is been luckily inserted for the dividend, that if dividend is taxable to foreign company at a tax rate less than 15% in the normal taxation, then it would be reduced while computing the book profit. So it's a welcome change for the corporate. Second, if one cooperative bank is facing some financial crisis, and in the restructuring of that cooperative bank, the other cooperative bank is taking over the vendor cooperative bank, then number one, the loss of the vendor cooperative bank can be carried forward by the purchaser cooperative bank. Number two, the transaction won't be regarded as transfer and there won't be any capital gain to the vendor cooperative bank. And number three, friends, under 44 DB, the depreciation, the preliminary expenditure under section 35D, amalgamation expenditure under 35DD, and VRS expenditure under 35DDA would be available to vendor and purchaser, vendor cooperative and purchaser cooperative, in the ratio of number of days for which they've done the business. Like today, if it is taken over, then till today, it is available to vendor. After today, that is from 9th February to 31st March, be roughly 51 days divided by 365. the out of total depreciation and total preliminary, it is available to purchaser, rest available to the vendor. So this provision 44DB was applicable only when the cooperative bank, only cooperative bank, no all cooperative societies, cooperative bank taken over by another cooperative bank. Friends, RBI has come out with the circular on 27th of September 2018, which says that we recognize the takeover of the cooperative bank, urban cooperative bank, by the banking company also. And there are many cooperative banks which are taken over by banking company. And to give the benefit, when cooperative bank is taken over by banking company, friends, same provisions of 44DB are being modified to cover not cooperative to cooperative. It would now cover urban cooperative bank being vendor and banking company being purchaser. So this is to give the benefit to the cooperative. Next set of amendment is for trust. Certain provisions are rationalized. Those friends of mine who are having the practice of trust would be unhappy. But yes, this is the provision. Number one. Friends, the first provision is corpus fund. Any registered charitable or religious trust, if getting corpus donation, specific donation, then this specific donation will be fully exempt, irrespective of condition of application, irrespective of condition of investment. On the other side, if the trust is getting general donation, then there is a condition that trust can accumulate maximum 15% unconditionally. Rest, either they have to apply for the purpose for which they are established, or they have to invest in section 11.5 securities. What used to happen was trust getting 1 lakh rupee donation. Now this 1 lakh rupee donation which is received by the trust is received by the trust as corpus donation, and assume trust has got 8 lakh rupee as general donation. Now, out of 8 lakh, trust has to apply 85% or invest 85%. 1 lakh, trust can keep as it is, and without investing, without expanding, simply by passing the entry bank account debit to corpus fund account credit, trust is able to avail the exemption. Now, many trusts have started making application of the same money received for corpus fund for the general application, because they were having only one bank account in which corpus donation is credited or the general donation is credited. Color of money is green. So whether you are expanding from corpus or whether you are expanding from general was not known. And this situation is addressed by the finance minister. He said that corpus donation is exempt subject to it is invested or deposited as per the means prescribed or investments which are prescribed under section 11.5, meaning thereby the corpus donation would now no more be unconditionally exempt. The corpus donation must be supported by investment. Like the first accounting entry will be bank account debit to corpus account credit, and the second accounting entry will be investment account debit to bank account credit. It should be deposited in the specified account. It should be invested in the specified fund. Then only it will enjoy the exemption. Otherwise, it will not enjoy the exemption. Now, from you, when you withdraw from the fund and expand, again, that would not be called application. So there is a restriction, or there is, I would say, some tight situation for the corpus donation, which is inserted prospectively. Second, assume my trust wants to start the educational institute for which they have to expend 5 crore. Trust has 1 crore, remaining 4 crore they have to take as a loan from the bank. Trust has taken 4 crore loan, 1 crore own money is invested in the capex for the school for the educational institute. And trust has claimed full 5 crore as application from general contribution and the other rental or dividend property income. Trust has said that capital expenditure is also application, and where it is written that it should be expended from my own money, even if it is expended from loan money, it is application. And it was well accepted Fine, I don't have any issue with this. The problem was when this loan taken 4 crore, trust pays the interest on 4 crore. That is also application legally justified. I'm okay with this. But the principal payment, repayment of this 4 crore was also been considered by trust as application. Meaning thereby, trust is getting double benefit. Once, when they are investing in the capex from the loan money, and second, when they are repaying this loan money. This was noticed by finance minister, and she said that when trust has taken the loan, then and if the loan money is invested, it is application. But friends, oh, I stand corrected. When the loan is taken by the trust and trust is expanded from the loan, then I am afraid loan money expanded is not application. Meaning thereby 1 crore your own and 4 crore loan is expanded in the capex. Only 1 crore is application. Remaining 4 crore loan, when you repay, that repayment will be considered as your application. So loan repayment will be application and it would be application when the repayment is made, not when the loan is taken and the expenditure is incurred out of the loan. So loan expenditure, the expenditure incurred from the loan would not be considered as application. And third, many trusts are having 100 rupee receipt from general contribution, and this trust are making outgoing of 110 rupee, having 10 rupee as deficiency. This 10 rupee deficiency for the trust was allowed to be carried forward. It was originally Matri Seva Trust, Honorable Chennai High Court, which was confirmed by Gujarat High Court, and it was also confirmed by Honorable Apex Court. To overcome allowing the deficiency to be carried forward, it has been provided that now trust would not be able to set off any deficiency, would not be able to carry forward any deficiency, meaning thereby this 10 rupee, if you have applied extra over and above the receipt, then you have to forget this 10 rupee. In the earlier year extra and you have deficiency which you were expecting to carry forward and set off in the year 21-22, I afraid no, you would not be able to do the same. This is an indication to trust that if you are applying more, you are charitable, you are religious, you are doing charity. We will not do any charity to you, allowing you to carry forward the deficiency. Friends, housing sector. There is a need of the boost to the housing sector, and that's the reason deduction under 80 IBA is been extended to 31st March 2022. The limit of 80 IBA for getting the plan passed, getting the approval was expiring on 31st March 21. That is further extended by a year. And second announcement is made by the finance minister that deduction under section 80 IBA would now also be available to rental housing project, which is notified by central government. This is to give the benefit to the migrant laborers, that if, say for example, in Gujarat, the laborers are coming from Uttar Pradesh or Bihar and they are staying in the rented premise, if builder has constructed rented premise, then on this rented premise 80 IBA would be available. How it would be available? What amount would be available? Whether rent earned by the builder be eligible for 80 IBA or not, whether it would cover PG house also, what area of the benefit is given, that is still to be notified by the central government. So we have to wait and watch for the notification. This is merely a small positive announcement made by her. Same way, first time home buyers, if taking loan for the house for which stamp duty value is up to 45 lakh, then they are eligible to get the deduction of interest under section 24B, that is house property. Along with that, they are eligible to get interest deduction under section 80 EEA also, additional 1,50,000. For this 80 EEA also, there is no change made. There is an enhancement of the time for sanctioning the loan. Originally, it was up to 31st March 20. That was extended last year to 31st March 21. And to give the boost to the housing sector, this is further extended to 31st March 2022. So if you are able to get the loan sanctioned up to 31st March 22 for your first house, you would be able to enjoy 80 EEA. This is major. Section 43 CA and 56 to 10. The intention for this particular provision is to give the boost to the real estate business, that too specifically to residential houses. The point is, if builder is selling a flat to Mr. X at 1 crore and the stamp duty value of this particular flat is 1 crore 12 lakh, then the point is builder is hit by 43 CA. 43 CA is applicable when immovable property, which is your stock in trade, is transferred. For builder, the computation of the business income should be made taking consideration to be not 1 crore, but 1 crore or 1 crore 12 lakh, that is stamp duty value, higher of the two, and that is 1 crore 12 lakh, subject to valuation officer. I am not involving. When this section was inserted in late 90s, if your selling price is 1 crore and your stamp duty is 1 crore 1 lakh, then also that sales price was to be taken as 1 crore 1 lakh. In fact, it was not there for the builder, but no variation was permitted. Thereafter, luckily, this government, Narendra Modi government, has permitted 5% variation. That 5% variation is increased to 10%. Now, what is 10% variation? If my sales price is 1 crore and my stamp duty value is 1 crore 10 lakh, up to 1 crore 10 lakh stamp duty value is, then I can take my sales price to be 1 crore only. I don't have to take 1 crore 9 lakh or 1 crore 9.5 lakh. But if it is going above 1 crore 10 lakh, then I have to take the total amount. Like if it is 1 crore 12 lakh, I have to take 1 crore 12 lakh. For giving the promotion to the housing sector, as the ministry is aware that there is tremendous recession, the price is going down. Between 12th November 2020 to 30th June 21, the Honorable Finance Minister has provided that for residential house, 20% variation is permitted. In place of 10, it is 20, meaning thereby, if builder is selling off the residence at 1 crore rupee for which stamp duty valuation is 1 crore 12 lakh, then builder can settle showing his sales price to be 1 crore only and not 1 crore 12 lakh, subject to the transaction is happened for residential house. If it would have been for office, it would have been 1 crore 12 lakh. The transaction has happened between 12th November 20 to 30th June 21. It is not for the whole financial year 21-22. Mind well, friends, the budget, this particular budget has got number of provisions which are applicable for PY 2021 also. Look at this. Look at leave travel concession. Friends, up to 30th June 21 only. And it is applicable for the small houses. What is small houses? Small houses means consideration received or occurring as a result of transfer doesn't exceed 2 crore. So it is applicable for the small, medium base houses only. Most important condition is it is applicable only for the first time allotment. Meaning thereby, if it is builder, this would be applicable. Builder allotting his house at 1 crore, the stamp duty value 1 crore 12 lakh, it is allotted to, say for example, Mr. A. Then builder would be taking sales price to be 1 crore only while computing his business income. In the hands of receiver, this 12 lakh is not taxable as gift and there won't be any taxability here. But my point is that if I am selling off my bungalow at 1 crore, stamp duty value is 1 crore 12 lakh. For me, my bungalow is my capital asset. Whether for me this particular benefit is given, answer is no. They don't want to encourage me. They want to encourage those who are builder, those who are first time, or rather those who are buying the home in first time allotment. Meaning thereby, if I am selling off my bungalow, only 10% variation is permitted and not 20%. Now it would be for first time allotment. The question arises, if builder has under construction flat scheme, each of say 1 crore he is selling. Stamp duty value is 1 crore 12 lakh. I have booked a flat number 306 and I have paid to builder 11 lakh rupee for an under construction scheme. He has given me allotment data and he has entered into the agreement to sale also. Assume now Mr. R wants to buy the same flat number 306. He approaches builder. Builder says that I have already booked it in the name of Palak. You go to Palak. If he is ready to relinquish his right, I am ready to sell it to you. That fellow comes to me. Our deal is crystallized at 1 crore only on paper plus something more off paper. Point is that I am taking my 11 lakh which I have given to builder and balance I am asking him to pay to builder and I am relinquishing my right. Builder is allotting the flat to him at 1 crore, stamp duty value being 1 crore 12 lakh. Whether this particular extended limit, enhanced limit of 20% be applicable in this particular case also? If you ask me, strictly speaking, no. Why no? Because it is applicable only to the first time allotment. It is not first time sale. It is first time allotment. If you manage your papers, play the jugglery with the papers and manage it and show it that it is first time allotment to R. It was typographical error. Palak is allotted 307 and not 306. Then you can get the benefit. Number two, in this case also, if something is flowing from that Mr. R to me, my account, then I am afraid, again, it would be a problematic situation. So the benefit is given, but this benefit is given with number of restrictions. Number one, industrial promotion, there is extension in the time limit. So I'm not touching upon the same much. 80 IAC. Originally, it was to expire on 31st March 21. Now it is 22 and 54 GB. Those individual HUF selling residential house or plot and investing in the shares of the eligible SME or eligible startup were allowed to get this benefit of 54 GB up to 31st March 21 sale only. Now it is up to 31st March 2022 sales made. Tax audit. Many my friends of mine, young friends of mine, are unhappy. Even many seniors are also unhappy with this particular limit of tax audit being enhanced, limit of tax audit being increased by the finance minister. The question arises that whether this is going to affect our practice. Answer may be yes. But I believe, friends, that take things very positively. GST reconciliation, GST audit is abolished. The section itself has been taken out of the statute book. I always believe that whatever happens for good. Be positive. From 1 crore to it was 5 crore and 5 crore to 10 crore. If I say this is for ease of doing the business for the businessman. Still, I am honest that there are a number of businessmen who are believing in not the legal compliances, which is a compulsion on them by the government, but who believes in the tag we have, that is CA. They believe in getting their books checked by us, certified by us, even if it is not legally required. The provision is up to 1 crore, there is no requirement of audit. About 10 crore, if in business there is sales turnover, gross receipt, there is a requirement of audit. But between 1 to 10 crore, last year it was up to 5 crore only. Now in the current year, between 1 crore, above 1 crore to 10 crore, the audit requirement in the business would not be applicable, subject to 95% of the total payments are by other than cash, and 95% of the total receipt, the word is and 95% of the total receipt is also by other than cash. That means only max 5% of payment side or receipt side can be by cash. Friends, if my client's turnover is 3 crore, everything is been realized, nothing in data. And out of 3 crore, his cash sales is only 10 lakh. No other incoming on the bank side, cash side, no other outgoing, then no other incoming on the cash side. Then friends, in this case, he's not required to get the books audited. Assume his purchase is 2 crore. Everything is been paid, but out of 2 crore, payment made in cash is worth 12 lakh. This 12 lakh is above 5% of 2 crore. Even if his turnover is 3 crore, he's covered by audit because his cash transactions outgoing side, payment side is more than 5% of the total payment. The word is receipt and payment, meaning thereby if my turnover is 3 crore and out of this 3 crore, I have realized only 1 crore 80 lakh, another 1.20 crore is there in the data, then I have to apply 5% limit to 1.8 crore. You may have a question that, sir, there are number of other incoming also in the business, like unsecured loan taken, like some other money coming. Then whether receipt will cover all these unsecured loan taken or other money? Answer is yes, but this must have been in-depth discussed last year. So last year's provision has been kept as it is, but the only change is the limit has been increased from 5 crore to 10 crore. No such increase in the limit is made under 44 ADA, but there is a small correction in 44 ADA, that is a presumptive tax system for we professional, that the benefit of 44 ADA can be availed by individual HUF and partnership firm if they are resident and not LLP. Major changes in the capital gain: if the premium of ULIP, and if ULIP is issued, not old ULIP, I have a ULIP wherein I pay the premium of 3 lakh rupee per year. That ULIP, if the money is received by me on maturity, when I am alive or after my death, my family receives the money. In both the cases, amount received from the ULIP will be exempted, even if the premium paid by me is 3 lakh. But if the ULIP is issued on or after 1st February 21, that is a day of budget, and the premium in the ULIP in any year exceeds 2,50,000. Earlier, there was only one limit of 10%, more than 10% premium over the sum assured. Now, the 10% limit remains as it is. Or if the aggregate premium exceeds 2.5 lakh, then on maturity of the ULIP, on death of mine, the money will be exempt. But if it is received by me on maturity date, otherwise than death, then the money received by me will be chargeable to tax under the head capital gain. Under 1010D, exception is provided, proviso is provided that in this situation wherein the premium paid for the ULIP taken on or after 1st February 21 exceeds 2,50,000 in a year, the maturity money will not be exempt. Corresponding change is made in 1010D and capital gain topic. In slum sale earlier, it was only sale was covered. Now it covers any transfer, not involving much. But two provisions on which I want to give more emphasis. The first one, there is a partnership firm in which I am partner. Assume I, along with Bhavya Bhai and Monish Bhai, have started a partnership firm. In this partnership firm, we have a building having WDV of 20 lakh. I want to retire from the partnership firm as I'm not able to devote much time, and these two fellows are working very hard. So they told me that either you give time or you go home. And I have my limitations, so I've decided to go home. I'm retiring. There is a capital balance of mine in the firm worth 27 lakh. And the firm has given me this particular building having WDV of 20 lakh. In full and final settlement of my capital account, the market value of the building being 35 lakh. Originally, the question was whether 45(4) will be applicable at the time of retirement of the partner. Honorable Bombay High Court in the case of A. Nayak and Associates has said that the word is dissolution or otherwise, and otherwise would cover retirement also. Now that controversy and the court judgment are, I would say, given the legal effect, saying that in the case of dissolution or reconstitution of the firm, reconstitution will cover retirement also, change in profit sharing ratio also. Anytime something is given to partner, 45(4) may be attracted if there is reconstitution. Second, now what is 45(4)? 45(4) says that if building is transferred by the firm to me, building is a capital asset, it's a transfer made by firm to me, retiring partner. So for the firm, difference between the fair market value of building, in our case 35 lakh, and the WDV of the building 20 lakh, that difference being 15 lakh will be taxed to the firm as capital gain. The issue was, for me, the partner, I am getting 35 lakh rupee market value building against my 27 lakh rupee capital balance. Whether this 8 lakh, which I have got over and above my capital account balance, be taxable to me as capital gain. The argument forwarded by the assessees are that capital account in the partnership firm is not a capital asset, not liable for capital gain. It was well accepted. To nullify this controversy, 45(4) bracket small b is inserted, providing that the difference between 35 lakh, that is the market value of the asset given to Palak, capital asset given to Palak, and the capital account balance 27 lakh, the difference between the two, 8 lakh is taxable not to Palak, but to the firm, to the partnership firm. Number one. So there arises a mechanism of double taxation. There the finance minister has said that we will give the appropriate announcement, will make the appropriate announcement to overcome this double taxation at a later stage. So we are expecting something from finance minister that she should relax the situation, because here she is taxing the firm only on building as well as on the capital asset of the partner also, or rather capital balance of the partner also. Now, out of this 27 lakh balance of mine, assume 3 lakh rupee balance is self-generated goodwill, which is credited to my capital account. Effectively, I have brought in only 24 lakh, or my remuneration interest credited to my account, profit sharing credited to my account, which is not withdrawn by me, is only 24 lakh. 3 lakh is credited to my account as goodwill, which is self-generated, raised goodwill. Then the difference between not 35 lakh and 27 lakh, difference between 35 lakh and 24 lakh will be liable as capital gain in the hands of firm. This 45(4)(b) applicable when capital asset is distributed. 45(4)(a) talks about the same mechanism. If my capital balance is 27, 3 lakh is self-generated goodwill, so it comes to 24. I am given the asset which is not a capital asset, other assets, or I am given money, and the aggregate of these two is 35 lakh, then also firm will be liable for capital gain on 11 lakh. So 45(4)(b) is when capital asset is distributed. 45(4) capital A will be when other asset is distributed. In the business profession, very quickly, if I cover up, in the business profession, employee contribution to PF, if deposited after the due date under the relevant PF Act, then it will now no more be disallowed. Sorry, now no more be allowed. I stand corrected. It would be disallowed. Our argument that employee contribution is also covered by 43(b) is nullified. Gujarat High Court judgment in the case of Gujarat State Transport Limited is a judgment which is well accepted in the law. There are other courts which are saying in the favor of the assessee, for which department has gone to Supreme Court and matter is sub judice before the Supreme Court. If you ask me, my humble opinion is that even if the matter pertains to earlier year, it won't be eligible for the deduction, and it would be hit by 36(1)(5)(a) employee contribution, and 43(b) limit is not applicable. Goodwill. 1st April 1998, when Yashwant Sinha ji has presented the budget of 1998, he said that if there is intangible asset purchased on or after 1498, then on this intangible asset, depreciation is available at the rate of 20%. He has made the correction in the definition of block under section 2 bracket 11, which says block means tangible and intangible asset being know-how, patent, copyright, trademark, franchise license, or any other business or commercial rights of similar nature. Or any other business or commercial rights of similar nature. Assume a situation wherein some assessee is purchasing the goodwill. He's purchasing the goodwill of business, whether he'll be able to get the depreciation on the same or not was a subject matter of controversy. Friends, Honorable Supreme Court in the year 2012 has said that purchased goodwill will be eligible for depreciation because it falls under the category intangible asset and it falls under the category any other business or commercial rights of similar nature. Self-generated doesn't have any historical cost, and as there is no historical cost, there is no question of claiming the depreciation. But purchased goodwill will be eligible for depreciation. The unfortunate situation was here many assessees have started making a planning. If X Limited is getting amalgamated with Y Limited, X Limited is fulfilling the conditions mentioned under section 47 and amalgamation is tax neutral, meaning thereby the vendor company is not paying any capital gain. Purchasing company is paying some amount to vendor as intangible asset and they were debiting the same to intangible asset account irrespective of, or rather than distributing this amount paid for intangible into various different assets like trademark or like licenses or like goodwill, because they were knowing that we will be able to claim the depreciation. But that is wrong actually. How come it is wrong? It is wrong, the reason being that in the hands of the seller, amalgamation is tax neutral. Vendor is not paying any tax while purchaser used to claim depreciation on extra amount paid by him as goodwill. This is noticed by my government. And to overcome the same, the change made is affecting everyone, saying that goodwill is excluded from the block. They have made the correction in the intangible block being trademark, copyright, patent, franchisee, license, or any other business or commercial rights of similar nature, not being goodwill of business and profession. Meaning thereby goodwill is specifically excluded. So now no more depreciation on goodwill. The unfortunate part is that as there is no depreciation available on goodwill, any depreciation provided till today would be reduced from the cost of goodwill. And for the purpose of capital gain, this reduced amount of goodwill, depreciated amount of goodwill will be taken into account. The point important is there is only one block of intangible, wherein assesses goodwill, copyright, trademark, all are lying. How to take out goodwill on which I have already claimed the depreciation, taking it to the block. I understand that if I now incur the expenditure on goodwill, then it won't qualify for depreciation, it won't enter into the block. But what about those goodwill which has already entered into the block and on which already depreciation is provided? Madam will come out with the mechanism still not provided. Second, what would be the situation when the seller is ending up paying tax on the goodwill as capital gain and I have purchased the goodwill? Will I be able to claim depreciation? Answer given by the lady finance minister is no, no depreciation. So friends, a dangerous amendment made by her. This would be leading me to last two categories. Bhavya bhai and Monish bhai, can I continue for next 5 to 7 minutes? If okay?
Yes, please, sir. Yes.
All right.
Please,
Thank you. Thank you very much. So my point is that here senior citizens are not supposed to file their ITR is the change. Now, this change is pretty subjective. Senior citizen is defined as the person of the age of 75 years and above here. He must be having pension income only. Along with pension, if he has interest, it would do. But interest must be from the same bank in which he has pension credited. That bank must be specified bank by the government. The government is going to come out with the list of the specified bank. And here senior citizen is supposed to give declaration to bank that my income is this, my interest is this, my general deduction is this, my 87A is this. You compute bank and you deposit my TDS. Bank will deposit TDS and senior citizen will not have to file the return. The question important is, it is the benefit given to the senior citizen was been highlighted by many, including myself, on various news channel on the date of budget. Is it really a benefit? According to me, no. It's pretty conditional. Imagine a situation that my senior citizen has invested years back in Reliance. I'm not talking about those senior citizens of the age of 75 years and above who are doing stock market every now and then. No. For them, definitely this provision is not applicable. But assume senior citizen has invested in the Reliance Industries Limited years back. He's not having any intention to sell Reliance, but Reliance has declared, assume the dividend of which senior citizen is eligible to get only 80 rupee dividend in his bank account, specified bank account, as dividend is now taxable in the hands of receiver. On receiving 80 rupee dividend, senior citizen is out of this particular provision. Friends, the conditions given are very, very harsh. Next, transfer pricing partnership form. The due date for the working partner or other partner would also be 30th November. This was a drafting lacuna since years, which is rectified by the finance minister. 5 time limits are curtailed by 3 months. Belated return under 139(4) can be filed only before 3 months of completion of assessment here. And revised return, the same time limit. Meaning thereby, if my financial year is 2021, my due date of filing of return non-audit is 31st July 21, audit 31st October 21, and transfer pricing audit 30th November 21. I can revise only up to 31st December 21, or I can file belated only up to 31st December 21. This is one. You have to be very quick. Department wants a quick reaction. So a very humble request to all my professional brothers. Please don't indulge into the practice of now demanding any extension from the government. Second, friends, there is a small change in defective. I am not involving. Second change is they have reduced the time limit for completing the intimation under 143(1). Earlier, it was 12 months of the end of the financial in which return is filed. Now it is 9 months. Assume you file your return on 28th of July 2021. Earlier, the limit was 31st March 23. Now it is 31st December 22. The notice of scrutiny time limit is also been reduced by 3 months. Earlier, it was 6 months of the end of the financial year in which return is filed. Now it is 3 months. And assessment also must be completed within 9 months from the end of AY in which income was first assessable, like my PY 2021 relevant to 21-22. Earlier, it was 24 months from the end of assessment year, which is reduced to 21, which is reduced further to 18, 15, 12, and now only 9 months. So the position will be due date of return, immediately there the due date of revised return or belated return, after that immediately scrutiny, after that immediately completion of scrutiny. So it would be a very hectic and very quick task. Department is shifting from test match to 2020. And one more, search assessment is been done away. No search assessment. For search, friends, remember that 153A and 153C are abolished for search conducted on or after 1st April 21. On or after 1st April 21 search cases and reassessment cases, the following procedure will be followed. Now it is called reassessment only, not search assessment. The position is, in reassessment, AO can take up the case. Earlier, the provision was AO can take up the case only when he has reason to believe. And there was a big controversy, what is reason to believe? Friends, reason to believe is a big subject matter of controversy. That reason to believe is done away. Now it is provided that if it is search case, survey case, or The AO is of the opinion, the department of the opinion that you are in possession of money, bullion, jewelry. Meaning thereby, if there is a search at my place and it is found that Monisba is also connected with me and is in possession of this money, bullion, jewelry, then Monisbai's case can also be without search be taken up for reassessment. I'm not using the word search assessment. In two cases, when there is a flagging of income by the department or audit objection by KEG, then officer will issue a so-cause to assessee asking assessee why your case should not be taken up for reassessment. If assessee is able to give the justifiable reply, it would not be, but not, then his case would be selected for reassessment. Reassessment can be done only up to 3 years, or search assessment, which is now called reassessment, can also be only up to 3 years. But in the cases where there is evidence of escaped income worth more than 50 lakh, it can be up to 10 years. If it is 3 years, the approval of principal commissioner of income tax level officer is required. If it is after 3 years up to 10 years, then the approval of the officer of the level of principal chief commissioner of income tax is required. No more reassessment beyond 10 years. In spite it is asset located outside India. Earlier it was 16 years. That is done away. No 16-year limit. And friends, here remember that beyond this time limit, notice of reassessment cannot be issued. So the positive point is time limit is increased. Negative point is the reason to believe controversy is done away. So officer would have now plenary power for issuing the notice of reassessment, subject to obviously the approval of the higher authority. Friends, as you are aware that assessment and CIT appeal is faceless. Same way they are planning to have tribunal also faceless by 2025. And very surprisingly, from 1st February 21 itself, the Income Tax Settlement Commission is discontinued. Whatever the pending cases are there before Settlement Commission would be transferred to interim board after constitution of the same. Friends, this is a dispute resolution committee for which still the conditions are, still the methodology is to get notified. It is just like Vivad se Viswas, so I'm not touching upon. I'm now going to only two last to close. One, on dividend, there is no TDS, was been highlighted on the date of budget. Under section 194, dividend on the shares of company, TDS is applicable at the rate of 10%. Now, remember that the insertion under 194 is that if the dividend is given to business trust who enjoys a pass-through status, income is not taxable to business trust. Income is taxable to the unit holder. Then company giving dividend to business trust is not required to make any TDS. And another insertion is any other person as may be notified. Now, we are expecting the finance minister to notify that individual HUF getting dividend, company doesn't have to make any TDS. That is what is our expectation. Friends, if you read the memorandum explaining the finance bill clearly, it states it is applicable to only those receiver whose income is exempt. Whether dividend income is exempt in my hand or your hand, answer is no. So don't expect that our name or our category would be there in this particular 194 for persons as may be notified. We would not be the notified person, number one. And number two, there is a drafting lacuna. Corresponding amendment is not made in the dividend for mutual fund under 194K. So under 194K, even if the dividend is given to business trust, I am afraid it would be subjected to TDS. Same way, there is no advance tax payable on the earlier installment for the dividend, except dividend of loan or advances, that is 222E. And the last to close, 194Q. Actually, Monish Bhai, Bhavya Bhai, Chintan Bhai, this particular subject topic needs huge deliberation and discussion. But In simple words, till now, goods were outside the purview of the TDS. Now they are saying that purchaser of the goods is also supposed to make TDS at the rate of 0.1%. Subject to purchaser has turnover in the business in the immediate preceding previous year exceeding 10 crore, and he is purchasing the goods worth more than 50 lakh. Then on such excess, if he has purchased the goods, say I am the purchaser, my turnover in the earlier year was 12 crore. I am purchasing the goods from Monish Bhai worth 55 lakh in the current year. Then I am supposed to make TDS on 5 lakh at the rate of 0.1%. If Monish Bhai has not provided me PAN, then at the rate of 5% on 5 lakh. This section won't apply if TDS TCS is made under any other section except 206C 1H. This 206C 1H was the provision which was inserted last year by the finance minister that talks about TCS in the case of goods or service. Now 206C 1H says every seller, it talks about seller, has to collect TCS if the sales exceeds 50 lakh. On the excess, TCS is collected by seller at the rate of 0.1%, subject to seller has turnover exceeding one or exceeding rupees 10 crore in the earlier previous year. Now, in next 2 minutes before I close, if I highlight one simple situation which I was just analyzing, assume X is seller and Y is buyer for the goods worth 60 lakh during the financial year 21-22. X seller, Y buyer. 60 lakh is the sales made by X to Y. Turnover of X in the earlier previous year is 12 crore and turnover of Y in the earlier previous year is 15 crore. Now seller has to collect TCS under 206C1H and buyer has to make TDS because condition of 50 lakh is fulfilled. Seller's turnover in the earlier year is more than 10. Buyer's turnover is also more than 10. So both the sections, in my opinion, will come at a time. But assume the turnover of seller is 8 crore and turnover of buyer is 18 crore. Then buyer has to make TDS as per 194Q. Seller doesn't have to collect the TCS as his turnover is below 10 crore. Had this been a reverse situation where seller's turnover is more than 10 crore in the earlier year and buyer's turnover in the earlier year is less than 10 crore, then buyer is not supposed to make TDS, seller is supposed to collect the TCS. If buyer and seller both are big means in the earlier year that turnover is more than 10 crore, then I afraid in this case, friends, both the sections may come simultaneously, and a harsh provision wherein TDS TCS is made at double the rate if your supplier or your vendor or your service provider has not filed the return of both the earlier previous year for which due date has already expired. You will be making the TDS or you will be making the TCS at double the rate provided. So this is going to be a big burden on various taxpayers on the line that how we will be able to find out that whether the person who is giving service to us, like a businessman, how we will be able to find out that chartered accountant providing service to him has filed the return of earlier 2 years or not? Is he going to go and collect the return of earlier years from the service providers? Difficult task, but that's what is the change made, friends, here. So this is what are the changes made by the Honorable the Finance Minister in the current budget. I'm thankful to Text today, thankful to Bhavya Bhai, Chintan Bhai, and Monish Bhai for giving me this opportunity. And I'm thankful to audience for listening me. Thank you. Over to you, Monish Bhai.
Palak sir, thank you so much. You have really touched upon the subject very well. Sir, just on the TDS and the TCS part that
Yes, sir.
we've just gone through, just a small question that comes across is 206C1H says, I am not well versed, but I think there is a provision which says that if TDS is applicable on any of the section, under any other section, then this TCS will
Good.
not apply.
Very right. Very right. That is what was the original interpretation I have made when I was reading the budget for the first time this year. But we have to definitely wait for the clarification, Monish bhai.
Right, sir.
Unfortunately, I would put this way that the later provision will prevail.
Exactly.
The later provision is the current year 194Q.
Q.
So that's the reason I'm applying both if seller and buyer both are having turnover above 10 crore.
Yes. So
And there is a
that's
specific
exactly.
there is a specific exclusion in 194Q that if TDS or TCS other than 206C1H is made, then 194Q is not applicable. There 206C1H is specifically excluded by the legislature in the bill.
Right, sir. That's a very valid point that you have come up with, and I'm sure that by this video, a lot of people would be able to clear out the doubts with regards to all the provisions that are hidden inside the finance bill, because what the madam speaker spoke, sorry, what the madam finance minister spoke was quite less, and when we read the in-depth uh, the budget speech, we come to know that there's a lot of hue and cry that can happen. And thank you once again, sir, for
Thank you.
going through all the provisions in such depth. And with this, we'll come to the end of our third lecture in row as far as in the dialects. We have covered all the three dialects known to us, that is Hindi first, then the Gujarati and the English. All the videos will be available online. So select your dialect and you can choose whatever you want to listen to. If you have any further questions, you can always come back to us, and our team of experts is always there to help you. And we will get in touch with all the uh, experts that have been coming across on Text Today on and off. I'll thank once again Druvang Bhai and Palak Bhai, who were the main people who deliberated today's budget session for us. Thank you once again, everyone, and thank you for joining in live today on
Thank you.
Text Today. Bhave Bhai, over to you if you have any finishing remarks.
Thank you very much. This budget series of lectures was actually brainchild of Monish Bhai. I thank Monish Bhai Shah for always being with us. I thank all the speaker for being cooperating us with text students, sparing their valuable time. Thank you very much, friends.
Thank
Thank
you.
you.
Thank you very much.
Thank you.
Thanks.
Thank